Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amaduri, and I'm joined today with Marc Faber, Dr. Doom, a returning guest of gloomboomdoom.com. And we're going to talk about what's been going on this year with what's going on with the illness, the lockdowns, the riots, the economy, the shutdown of the economy. And now we have a November election coming up. The president just announced that he has COVID. So there's so many dynamics. It almost seems like a movie playing out right before our eyes, and conspiracies are becoming realities, and the world is just changing. So it's a pleasure to have Marc on the line. Marc, thanks for coming on Crush the Street with me today.
Well, my pleasure. Thank you for having me.
Well, just a response to what I said there in the introduction, would you respond to that and give some of your thoughts?
Well, as you said, a lot of things are happening, but I think there is an overriding issue or factor or condition, and that is the printing of money by central banks. You understand? As an example, today the market opened lower because some people thought, oh, if Trump has COVID, it's bad. But what is bad and what is good is all relative. And whether he has COVID or not, if money printing goes on, then assets don't have a huge downside risk. And whether a Trump presidency would be good for the stock market in the next 4 years, or whether a Biden presidency would be better, who knows? That we don't know. But we know the central bank has announced they'll keep interest rates, or that is their view. They said they would try to keep interest rates at next to zero for 3 years, and they'll buy assets to the tune that was announced of $120 billion monthly. Now, maybe they have to increase it and maybe they'll decrease it in future. But the fact is, that is what they're telling investors. And then investors say to themselves, well, if this is the case, then rather owning cash that doesn't give us any return, we buy assets such as stocks or properties in the countryside or precious metals or maybe other commodities.
So what are your thoughts on the inflation rate? I know the Fed is trying to keep interest rates low, but they're trying to target 2%. They can't seem to get there. And they're now talking about overshooting if need be, getting that inflation to go higher at all costs.
Yes, but I think your listener must realize that inflation is a concept that is not easy to measure. First of all, say you are single. Your inflation rate as a single is very different than the inflation rate of a couple with 2 children that will go to school and where the whole family needs health insurance and so forth and so on. Especially if one of the members of the family becomes sick, then the healthcare expenditures can become very burdensome. So what I want to say is, the way the Fed looks at inflation may not reflect the actual cost of living expenses of the typical household. And all I can say is that since I really talk to a lot of people, for the last 20, 30 years and so forth, middle class households have been squeezed. In other words, they have to spend more money. They don't have the money to pay for the studies of their children. That's why student debts are exploding. It's not just that more people go to university, but the system has become quite expensive. And I think the cost of living increase, if I look at myself, are higher than 2% per annum. So that is a figure that is very questionable in the first place. Number two, if you look at asset prices, stocks, bonds, collectibles, art, and real estate for the last 20, 30 years, it's gone up a lot. You know, there has been a huge asset inflation, and the Fed doesn't take this into consideration. They think it's very good. But why do we have so much unrest and riots and discontent everywhere? It's because young people can't afford to buy these assets anymore. And if they buy these assets, they buy at a very high price, in other words, at a very low yield. So for a lot of people, it doesn't make any sense to save. So the Fed has created a lot of social problems. And of course, they will never admit that because they don't want to undermine their own power. They are the kind of worst bureaucracy that you can imagine. They damage the system. They don't care about individual people. They only care about themselves and their academic achievements and giving speeches, and after retiring from the Fed, still getting their overpaid salaries and giving more speeches and getting consultants fees from companies like Goldman Sachs and the hedge funds and so forth, which they benefited in the first place.
It's an interesting point you bring up about inflation impacting different segments of the population differently. And one thing I'll point out, obviously for retirees, many of them may be more settled in certain instances. Maybe they have their house paid off, or their house was purchased in the 90s or, you know, the 80s, and they have, you know, certain situations that are not going up as much as someone, you know, middle-aged or just starting out. But what's hurt retirees is this zero interest rate environment where maybe you had $5 million, you know, to retire on in the early 90s, and you were able to get a real return on a risk-free bond. And now you need 10x that dollar amount to get the same sort of return. So people are pushed further out on the risk spectrum. So maybe speak to that as it pertains to this current environment.
Well, I agree with you. You know, the Fed is essentially forcing people to speculate. That's when you look at the Robin Hood traders and so forth. They got some money from the payments that the government gave them and so forth. But also they have some money on which they get no interest on their savings. And then they go and speculate. And that attracts more people that also speculate and so forth. So the Fed, and it's not only the Fed, and other central banks in the world with zero and less than zero interest rates policies, they have encouraged speculation and risky asset purchases by people that probably shouldn't own them. Number two, I just like to say, when I grew up, and people always ask me the question, say, what asset has no risk? And I tell them, well, when I grew up, was money in the bank was safe. You know, people said, you save 10% of your income, you put it in the bank, and that's good. And my grandparents and my mothers and my father, they did that. But nowadays, cash is not safe anymore because the purchasing power of cash is going down, through negative interest rates in Europe, in the US, zero interest rates, but rising asset price. So compared to, say, precious metals, cash has lost its value. It's lost its value compared to some properties.
Right. It's so interesting, the optics of all of this, because when you compare cash to something like gold or real estate or stocks or these hedges against inflation, you see what is happening to cash. But I think optically for the conventional person, cash is relatively stable. They look at gold go below $1,900 and then they're like, wow, that was a volatile situation, or cryptocurrency,
Yeah.
or watching the stock
Yes.
market. You know, they perceive cash as stable, and they can't quantify that really it's not stable when you have the Federal Reserve printing trillions of dollars, the government printing trillions of dollars, and throwing everything they can to maintain the system. But yet optically the dollar is the safe haven. Maybe speak to that.
Yes, it is safe even up to now, and its strength against some currencies has surprised me, but it's gone down against the euro and the Swiss franc and the yen this year by 4 to 5%. And the China bashers who always said the Chinese currency will collapse and the Hong Kong dollars will collapse, that hasn't happened yet. In fact, these currencies are up against the US dollar this year. But you understand, a dollar can stay strong for a long time before it collapses. Sometimes in these kind of economics we have, it's like, I remember I turned very bearish about oil in 1979, 1980, because it had reached $50 on the spot market. And I went at the time a lot to the Middle East, so I had an idea about the supply and the cost of oil. So I told all my friends, you know, oil will go down, and it will go down to say around $12 a barrel. And it didn't happen between 1980 until 86, 85, 86, it then collapsed to $12. So things can stay high, and they can stay irrational for a long time before they collapse. If you look at companies that go bankrupt, before they go bankrupt, they may double 3-4 times on the way down. A stock goes from 100 to 50, then it doubles back to 100, then it goes to 30, then it doubles to 60, then it goes to 20, doubles to 40, and so forth, and then it goes bankrupt. And sometimes a company that goes bankrupt stays at the high level for a long time, and in one day it collapses by 50%. I've seen that. So the fact that the dollar has held up, and I think the dollar is the Achilles heel of the US. In other words, as long as foreigners buy US assets, as long as they believe in the reserve currency status of the US dollar, everything will kind of hold together. But that may come to an end, in my view, and that's when things will unravel. It may not be tomorrow, it may be in 3-5 years. But in the meantime, all I can say is that the money printing that we have today and the support packages, the fiscal packages by the Trump administration, they are not helpful for the economy. That I can tell you. They're damaging for the economy.
Mark, and again, thank you for articulating that. One thing I'd like you to expand on is oil. If you would, if you have some recent thoughts on it. Obviously, with what's going on, I know California's governor vowed to not be selling new cars that require fossil fuels by a certain date. I think it was 2035. So this is kind of a trendsetter for what the future holds for oil. What are your thoughts longer term for companies like ExxonMobil, Chevron, and these companies that have high dividends, but are in a trend that is globally declining, arguably?
Yes, there are many aspects to this question. The first is I want to respond to what the governor of California is saying. Governors in the US and politicians worldwide, they will check what do voters want to hear. What is the majority interested to hear? What is the young generation interested to hear? So they see, oh, the young people, they want climate change measures and so forth. So then they voice the opinion, okay, we will get rid of fossil fuels. Has the governor ever made an analysis how much energy and damaging impact on the environment wind farms have? Has he ever made an analysis about how much waste and pollution the dismantling of batteries will cost? He's never done that. You understand? I think maybe what will turn out of all serious research is that actually fossil fuel is the least damaging for the world as it stands, and that everything else will be more costly. That is something to consider for the world. How I also like to have certain things in a better way than they are now. The question is, who's going to pay for it? Are you willing to pay 10-20% more tax on your income to have all this nirvana on earth? The young people have no money. They don't pay any tax. Of course, they want this to happen because they don't pay any tax anyway. So the point is, everything has to be analyzed in terms, what are the expenditures to produce heaven on earth? What is the cost? It's like if you say, oh, I want a society that is fair, and I want a society where everybody feels safe and so forth. Yeah, but what is the cost of having no crimes? You need a policeman in every apartment building, not one, several.
Mark, what's your instinct then when it comes to these oil giants? What's the future look like for them? I know it's hard and
well,
it's
at the
nuanced.
moment, it looks very bad. But in the meantime, they're, of course, very cheap. The stocks have gone down. And I know some people who saw that coming. They've been shorting Exxon for years. Jim Chanos has been shorting Exxon for years because he said it's a destruction of value. The company has falling reserves and has high dividends and so forth. So I think that as a contrarian, there are two sectors in the US, or maybe three sectors, that are very depressed. Number one, banks. Banks are very cheap compared to everything else. They're also the most hated investment at the present time, along with energy. Energy, fossil fuels are out of favor. And you have all these consultants in the pension fund industry. They will tell the pension funds and the endowment funds, you're not allowed to own any energy stocks because this is against the environment and so forth and so on. So there is selling pressure on both banks and energy stocks, and of course also on commodity related stocks. They are very depressed, with the exception of gold mining shares. They have risen, but energy stocks are extremely unpopular. And if someone buys energy stocks, he really makes a bet that some scientists will prove that energy, the way it is actually produced with fossil sources, is actually environmentally not that unfriendly.
Well,
I own some energy stocks. They haven't done well, but I own some.
Yes, I do too. And I believe that there is a value play there, but there's something to be said about the trend. I mean, look at what's happening in the tech sector, overvalued on paper possibly, but who's to say Tesla's not going to continue going higher? Amazon and Netflix and Facebook. I mean,
yes, I agree with you. The only thing I have to say is the risk is also very high. I just looked today at Cisco. Cisco peaked out in year 2000, and today, and this was the must-own stock. Is like every institution said, I can't afford not to own Cisco. So this was the favorite stock. It's like in the late 80s, people said, I can't afford to own Japanese stocks. I don't like them, they're too high. But if I don't own them and the market goes up, then I lose out because my competitors own Japanese shares. And so a lot of stocks that are owned today are owned because if you don't own them, you may underperform the market and then you lose your clients. You understand? There's a career risk. But a lot of today's favorite stocks, essentially the FANG and related stocks, the New York FANG index is 10 different companies. I think is actually a good short. I think in 10 years' time, it will be at half the level it is today.
Wow.
I'm
Yeah,
not
and
making
it's
a
interesting. It
recommendation
goes
here to your listener to
it goes
sell
back to what
it
you're
short,
saying.
but I think this is going to be the case.
I think it goes back to what you were saying though about the Robinhood traders, because so many of the millennials that have just gotten their checks and wanted to get into the markets, didn't have a job, wanted to speculate, are getting in at these high valuations and buying these tech stocks, buying Amazon, buying Facebook, buying Nikola and all these tech stocks. And sure enough, the markets have a way of sucking people in, getting people in at the highs, and then crushing them. And then when there's value opportunities on the table, like energy, like precious metals, people don't want to hear about them because they're basing their
Correct.
decisions on their most recent experience. So maybe respond to that. And as we wrap up this interview here, just speak to the idea of being a contrarian, somebody who, and maybe you could tell your story a little bit on how that happened, how that evolved. I kind of, that resonates a lot with me, being an entrepreneur, being a contrarian, not going with the grain on so many things. And that's just very interesting to me. So if you would respond to that first part, but then as we start to close it out, respond to that.
Well, when I started to work in 1970, they had in America a group of stocks which they called the Nifty 50. These were Xerox, Kodak, Polaroid, and so forth, also Sears. And they were all valued at very high PEs, and the rest of the market was very cheap. And these very highly valued stocks, these Nifty 50, they continued to go up until January 1973. And then they all went down 70, 80%. And two of the most popular stocks at the time among these Nifty 50, one was Kodak, the other one was Polaroid. Both essentially went bust, and Xerox as well. So that teaches you something. Avoid the most popular sector. And then during the 70s, as you know, gold shares did well, commodities did well, and energy related stocks. By 1980, energy made up for 28% of the S&P 500, and lots of stocks were in the sky, and they were the equivalent of the Teslas today in the form of Dome Petroleum. Eventually, Dome Petroleum went bust, but it took a while. And then, out of nothing, the Japanese market went up, and suddenly was 50% of global stock market capitalization in 1989. And then after that, it also collapsed. So it basically paid in the long run to avoid the most popular stocks. Of course, in an ideal world, you buy the most popular stocks 2 years before they peak out. In other words, you bought the NASDAQ in 97 and you sold in 2000 and so forth. Or you bought the US market in 2005 and you sold out in 2007. But nobody's perfect in the timing of these things. All I can say is that if you look at long-term return charts, usually value exceeds growth stocks in terms of performance in the very long run. That doesn't mean that for 10 years, growth can outperform value. Of course, someone will say, well, we have to also kind of analyze what is value. So maybe banks today and maybe oil today are not value, but you can say to yourself as an investor, okay, I'm not going to put all my money into banks and into energy stocks, but I put some money into these investments, and I put some money into investments that are very overlooked at the present time. And I would count among these investments emerging markets and also agricultural commodities. Agricultural commodities, I'll say, if you compare it to the price of gold or to the price of the Dow Jones, they are incredibly depressed. So I think that investors would do well to maybe buy a property in the countryside, an agricultural property, or invest in some commodity-related equities. That would include, say, commodity trading companies or fertilizer companies and so forth.
Yeah. Well, and it really goes to show that idea of chasing greed or growth versus protecting your money, not losing. And when you think about it from that perspective, it makes you change your mindset on where to put your value, capturing equity, look for the deep depressed markets that are probably not going to go any lower, you know, or too much lower, and not chasing things that have a lot of room to fall. So Marc Faber, everyone, of gloomboomdoom.com. It was a pleasure to have you on the show.
Well,
Get your
thank you,
insights,
Kenneth.
sir. So thank you for
Thank
coming
you so
on.
much. And I wish you a nice festive season.
Thank you, sir. I'm looking forward to the elections and the entertainment
a successful
value.
Election. The outcome doesn't matter.
It really doesn't. I know. All right, sir.
Okay,
Thank you so
take
much.
care. Bye-bye.